Hey, Jason here. Today's video we're going to cover Palantir. For Jessica C, I'm going to answer the question, should you invest in Palantir? For Jessica C, who asked me to evaluate this stock on YouTube. Before I get to that though, I need to let you know you can get this here as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, Spotify, SoundCloud, iTunes, and more. You can get this as part of the Value Investing in Your Car series anywhere in the world for free. If you like this content or other content, make sure to subscribe and hit the notification bell so you're notified every time we release a new video, and I'm releasing new videos all the time. Okay, before we get to the analysis again, I have to make this disclaimer because every time I forget, people leave nasty comments. So these are for educational purposes only, using my investment preliminary analysis checklist, which you can get for free, the written copy, at the end of this video. I do not short stocks ever, so I don't benefit talking negatively about any stock, and I don't own any stock on a long position. On any stock I talk positively about. These are for educational purposes only, to help you learn things to spot and figure out how to become a better investor faster. Why should you listen to anything I have to say? In the first 9 years of my career, I produce average investment returns in the portfolios I manage of 23.55% per year, every year on average. This is right behind the 24.2% that Warren Buffett produced. Sorry, I'm struggling to talk today. Produced in the first 9 years of his career, and these numbers legitimately make me one of the best stock pickers in the world over the last 9 years. I'm not saying that to brag. I'm just saying that to give you some context that I actually know what I'm talking about a little bit, to help you figure out. Again, this is all towards you to help you become a better investor faster. So, with that said, let's get to the write-up, or not the write-up, the analysis. So again, I don't know if I'm saying this right. Palantir, I don't know. This is requested by Jessica C on YouTube. So Jessica C, this investment analysis is for you. Okay, so I know a little bit about this company. I'm a big admirer of one of its founders, Peter Thiel, who also helped co-found PayPal with Elon Musk and a bunch of other people back in the day. He is a co-founder of this company, so I know a little bit about it, and I greatly admire Peter Thiel, and his 0 to 1 book is phenomenal. Highly recommend it if you haven't read it. You should read it. So there is, again, I want to be upfront about this. I am a little bit biased to this company, or biased probably to like this company, because of Peter Thiel and my admiration for him and the multiple companies he's built, and the book 0 to 1. But I'm going to try to let this rest on what the numbers say, and I can tell already that may not be a problem, because as I've talked about in other videos, I don't care much for PE, but having a forward PE of 192.3 is absurdly high. So this company may be absurdly high valued, which frankly, it won't matter what the numbers are then. I do know they recently IPO'd. I don't know how recent that was, though, and it doesn't say on here, but nothing else of major note on here. Again, talk about price of sales. I don't care much for price of sales. I've talked about in other videos. But again, this being at 24.1 is another sign the company might be overvalued, or especially when you consider the forward PE being crazy high there. Okay, so like with the Airbnb analysis that I did, again, and all the other videos in this series you can find for free below in the description. This is going to be a little bit different because, again, I don't know when they IPO'd Palantir. I do know it was in 2020, so their financial data does not go back as far as I would like. Normally, again, I want to see these completely full here with 10 years of data, but that's not possible because this company recently IPO'd. Okay, solid revenue growth, huge operating losses, hugely negative operating profit margins, hugely negative net income, share dilution, interesting. I wonder if these were kind of private shares per se, or because there's a huge jump in 2020. And again, I'm pretty sure when did go public? Yes, September 2020. So I'm assuming this is from previous rounds of investment, is what these shares are here, these 716 and 979. Because they really, I mean, they haven't been public very much, so they haven't really had time to dilute shareholders. Not a great sign again here, as I've talked about in previous videos, but with a high growth stock like Airbnb, it's not a gigantic deal because you still need to grow the company, but you can't do that with fundings from operations because your operating profits are hugely negative. Free cash flow, again, negative. This is turning out to be, can't check the ROIC. This is turning out to be very similar so far to the Airbnb analysis, which is to say there's not frankly much to say so far because everything is massively negative because they're huge growth stock and also they recently IPO'd. So hugely negative free cash flow to sales. Balance sheet is interesting. Their cash and short-term investments make up almost 75% of their balance sheet. That is very interesting, and that is very good. Debt, they have low debt levels. Again, great. Their balance sheet is super clean for a growth stock. Total liabilities only make up 43% of their stock, or of their balance sheet, sorry. And their huge cash pile is very interesting to me because I want as much margin of safety as possible. Again, being a data company, if you aren't familiar with this company, they are a data and kind of software and AI company that have contracts with government contractors and commercial contractors, so they don't really have a cash conversion cycle. That's mainly for companies that sell hard assets, so that makes sense. Hugely negative interest coverage ratio. Here is interesting. Again, I've talked about this in several videos, but this means with it being negative and with it being hugely negative, it means the company cannot cover its current interest payments on its debt with its net income or operating income. Again, I don't know how Morningstar collects it or calculates their data, but it's typically on net income or operating income. When it's negative, it means the company isn't earning enough profits to cover its current interest on its debt, which makes sense because the company is massively unprofitable. So how are they staying alive? By going public and raising a ton of money. Normally that's by issuing shares. I would say issuing debt, but they don't have a ton of debt based on their balance sheet, which we're getting to here. And they don't. They have $2 billion in cash, and they have about 460 million in debt. So they're raising it, staying alive from the IPO, and then before the IPO, selling more shares to either new or old investors. This is the Airbnb or the Uber model, whatever you want to call it. Continuing to fund growth by selling more shares to investors before you go public and then raising a ton of money. Okay, balance sheet. That is, again, that's awesome. I'm frankly shocked they have that much cash on hand. Again, as a long-term value investor, I want as much margin of safety as possible. This is a large margin of safety here because they don't have much debt, which we'll get to in a minute. It's not a gigantic margin of safety because this isn't really close to their market cap, which was almost $49 billion. So it's not a gigantic margin of safety, but it does add a large margin of safety that they have more cash than debt, which again, frankly, doesn't happen very often for high growth stocks. Okay. Again, frankly, their balance sheet is super clean for a company that not only recently IPO'd, but also one that's losing a ton of money, which is what you see here in the retained earnings accumulated deficit category. Again, I've talked about this in some other videos. You can see those below. Frankly, there were so many videos at this point, 40, 30, 40, 50, somewhere on there, that I don't remember which videos we talked about this in. So I'm just going to start talking about these a little bit more again. Give you more context here. When this is positive, it's called retained earnings. When this is negative, it's called accumulated deficit. Right now, or what this measures is the entire accumulated profits or losses of the company over the entire history of the company. So in this case, because it's negative 4.97 billion, that means over the entire history of the company, it's lost almost $5 billion in, I think this is based on net income. It's not a gigantic deal for a public company, but you typically want to see this going up, or in this case, positive over time and then up, because it means the companies are earning profits, and it can use those profits to reinvest in the company. This is a drag on the company's valuation because instead of using their operating profits or the free cash flow to invest in the stock, or to reinvest in the stock and to grow the company kind of in a quote unquote healthy way, this company is again having to sell shares to shareholders before it came public to fund the growth of this company because they're massively unprofitable, as you see here. Again, for a high growth stock, it's not a huge deal, but it is still a drag on this stock. I look at retained earnings, if it's positive, as a sort of rainy day fund. This is money the company it has in essentially excess capital that it can use to reinvest in the company to, again, fund future growth, all that kind of stuff I just talked about. Okay, cash flow statement. Let's see if we see anything interesting here. A huge loss. Okay, we already talked about that. Stock-based compensation. In the last 12 months, again, they recently IPO'd, which is why you see this huge, almost $1 billion number here in the third quarter. They IPO'd, and a lot of their insiders and previous investors, or probably insiders mainly, insiders and executives got some huge stock-based compensation. So that's why that number is so huge there, which again makes sense. Nothing out of the ordinary here on the balance sheet, or here on the balance sheet, or here on the cash flow statement yet. Proceeds from issuances of common stock. Okay, again, that's related to the IPO. See the huge spike here in the second quarter and third quarter of 2020. That's from the IPO. Over last year, it's actually paid off more debt than it's taken out, which again was great. But yeah, nothing super interesting here either, in a negative way, which is frankly shocking for a high growth stock. Most of the time, I see a bunch of gigantic red flags for high growth stocks on their balance sheet and their cash flow statement, but this is really clean. Here's where we'll get to the fun stuff, though, because I already know that this is going to be massively overvalued just from looking at the cash flow, which I don't know why that's positive, because they had negative cash flow in the last year at 850. But again, so how do you, and I went over this in the Airbnb video, but I'm going to do it here again as well, because these metrics are pretty much useless because they aren't earning profits, they aren't earning net income, they aren't earning operating income, they aren't positive on a cash flow basis. How do you value and evaluate a company that is unprofitable? The way I do it is to do this. So it's a almost $49 billion company. In case you missed the Airbnb video, I'm going to go over a somewhat faster version here. If you want to watch that, make sure to look, or if you want fuller context, make sure to look that up in the Airbnb video further below. Get out of here, add. Okay, what I'm looking for is a company of a similar size in terms of market cap. Oh, that jumps up really high. To Palantir. So they were 48, almost $49 billion company. So let's go with, Palantir. Let's go with Vodafone, because I'm not sure. Normally I would have gone with Marriott, but frankly with last year and their huge their huge down year last year due to COVID and their hotels either closing or being at far lower capacity due to lower travel and COVID restrictions, stuff like that. I don't know if they're profitable. So let's go with Vodafone. I'm pretty confident they're going to be profitable. Because to be able to compare them the way I do, the company has to be profitable. It doesn't make sense to compare an unprofitable company to another one if you're trying to figure out a kind of a basic valuation for the company. Okay, so I can tell right here they are profitable. Okay, that confirms it. So, okay. So here's what we're going to do. Bring this up. Oops. Forgot to get the Palantir numbers. Oh, they're still there. Good. Okay, so here's what we're going to do. Palantir, these companies are valued about the same in terms of market cap. And this is what they are priced at on the market. And actually, this is not correct. So, they are close still at 49 billion for Palantir and 53 billion for Vodafone, so it's not a huge deal. But you want to get these as close as possible, and frankly, this is probably as close as we're going to get. To do this, though, what I do is literally the exact process I'm about to show you. Revenue in the last year was $44.5 billion in euros. Oops, now we need to go to euros. And again, this process you're looking at is the same exact process I go through every time I look at a stock. So, was it 44.5 rounded up? So that's $53.1 billion in revenue in US dollars. Compared to $1.1 billion in revenue for Palantir. In the last year, Vodafone earned $9.1 billion in operating income, which is in euros, which is almost $11 billion in US dollars. Palantir had negative $1.2 billion in operating income. Net income, negative $1.2 billion in net income for Palantir. Positive 2.52, so 2.52. So that's $3 billion in US dollars. Free cash flow, 9.55 billion euros for Vodafone, which is $11.4 billion US, compared to negative $309 million for Palantir. So what this shows you is that even though they have about the same price on the market, this is very important, price and value are two completely different things when it comes to evaluating a stock. Price, there's a saying, I think Benjamin Graham, the father of value investing, said this: price is what you pay, value is what you get. So in this case, the price is what you pay on the market, but the value is what the underlying assets and profitability and cash flows of the company are saying it's valued at, or is what it's valued at. What I do as a long-term value investor is I want to, let's say the stock is worth $100 per share. I want to buy at $80 per share or below based on the value. The price in this case is $100. The value that I want to buy underneath is $80. So the company has to have a per share value of at least $80, or no, let's reverse that. So if the price is $100, I want to buy at, say, lower than $120 per share, if that is the value. And again, this is kind of a fuzzy concept to a lot of people because most people think price and value are the same thing. So I hope I'm explaining this pretty well. If not, let me know in the comments. But I want, if the stock price is $100 and the value is around $100, I want to buy below, let's say, $80 to have a margin of safety. If the company is selling, let's reverse this. So let's say the value of the company, or the price of the company, is $100 or $80, sorry, and the value is $100. This is probably a better way to explain it now that I'm saying it out loud. If the value, or if the price of the stock is $80 and I peg the value at $100 per share, that's a decent margin of safety. That's what I'm looking for. I'm looking for undervalued stocks as a long-term investor. So what this shows you here is that revenue is about, what, 52, I think is what it was, $billion US for Vodafone. So they have about 25 to 30x higher revenue than Palantir. They have enormously higher operating income than Palantir because they have about 11 billion US dollars in operating profit in the last year, while Palantir lost about, was it $1.2 billion? Yeah, $1.2 billion in the last year. So on all metrics, Vodafone is the far more valuable business based on revenue, operating income, net income, and free cash flow. It's not even close, frankly. Again, 25x to 30x higher revenue, and Vodafone in the last year created more operating profit, net income, and free cash flow than Palantir has done in its entire history. But they have about the same price in terms of the market. To further illustrate that, let's go to Vodafone's valuation, which gets us back to the original point, is how to value a stock that is not profitable. I don't care much for PE or price to cash flow or forward PE, but when I do look at these, I want them to be under 20. So these show that Vodafone is slightly undervalued to decently undervalued. The most important number on here, though, is EV to EBIT. To me, this is the most important number because I think of owning a stock as owning an entire business. And I want to know that the company, or I want to know what the company's cash and debt levels are, which shows up in enterprise value. That does not show up in price or market cap. Market cap is simply shares times price. And that's how you find the market cap. But since 99% of companies on Earth have cash and or debt, I think this is a far more accurate number, enterprise value, than just the market cap. For this number here, at 16.1, I look for a stock to be selling at a enterprise value to EBIT below 8 to consider undervalued. So, by this estimation, Vodafone is insanely more, produces a ton more revenue, operating income, net income, and free cash flow than Palantir. Again, not even close. And by this one metric, it's still 2 times overvalued compared to its profitability. So that puts Palantir at essentially an infinite valuation here on this number. Again, it's not really an apples to apples comparison because operating income, it's unprofitable on an operating income basis, and it's a high growth stock, while Vodafone is a legacy carrier. It's not exactly an apples to apples comparison. But when you're trying to value an unprofitable stock, this is what I find the easiest way to do so, and the best way, frankly, to do so. Because they have about the same price on the market, but their values are wildly different. I would value Vodafone at far higher price than Palantir, but it's still 2 times overvalued on this one metric. Which again means Palantir at far less revenue, profits, and cash flows is insanely overvalued right now. Could it get there at some point? Yes, but this is why I don't. This is frankly why I don't invest in most high growth stocks, pretty much any high growth stocks, frankly, is because I require my investments. I'm trying to get the screen back here. I require my investments, unless it's some kind of NCAV super undervalued situation, I require my investments to have profits, cash flows now. I want them to be profitable, to have competitive advantages. I want them to have all that stuff now, not in the future, because the future is incredibly uncertain. As we saw in the last year, when this time almost exactly last year was our last normal week for an entire year for most of us, as we've been locked in our houses for most of last year, due to a mostly unforeseen circumstance with COVID. Because of the highly uncertain nature of the future, obviously, I don't put too much stock into the future and what a company plans to do. Again, yes, I highly admire Peter Thiel, love his book, 0 to 1, one of my favorite books ever, actually. But the numbers now not even come close to backing up the valuation of the price of the stock. The valuation is absurd for Palantir right now. Good for them for getting it and IPOing and making all that money. Good for them. But as a stock buyer myself and considering buying this, there's no way I'd invest in it right now. Because there's so much uncertainty and there's so much, the valuation again is just absurd for Palantir. And I hope I illustrated that well enough. Again, I don't short stocks and I admire Peter Thiel. So I hope this works for him and the other investors, and maybe Jessica C is an investor because she wanted to know about this stock. But for me and what I require from an investment, there's no way I can invest in it right now. Yes, I know, as I explained in the Airbnb video, this means I miss out on high growth stocks like Uber, Palantir, Airbnb. But most high growth stocks end up blowing up unless they can produce profits and cash flow. Because at some point, all of the, not necessarily free, but all of the free-ish ways to finance your company's growth, issuing stock, issuing debt, all that kind of stuff, goes away at some point if the company doesn't turn a profit in terms of profits or cash flows. So I hope this helped. I hope this has been interesting. I hope you learned something. If I didn't explain something well enough, if I should explain something better, let me know in the comments below. If you want me to evaluate a stock for you like this, let me know in the comments below. I've evaluated at this point 30, 40, 50 stocks, and I think more than half of them have been from people requesting that I analyze certain stocks. So, and just on my calendar right now for this week, next week, and the week after, taking us to the beginning of February, every single stock on here is requested by somebody on YouTube. So if you want me to evaluate a stock for you, let me know in the comments below, and I'd love to do so. The only stocks I will not look at are banks, because I don't evaluate them, and insurance companies, because you have to actually dig into their annual reports to figure out if they're a good company or not. Other than that, I'll look at any companies worldwide. If you like this information, make sure to like, love, share, comment, all that good stuff on YouTube. And hit the notification bell so you're subscribed and so you are notified every time we release a new video, and release new videos all the time. If you're listening to the podcast, all that same stuff, we'd also really appreciate a review as well, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more information on how to become a better investor faster, you can get some free resources below in the description. You can get access to my 5 free gifts, which includes the full written valuation template for this that you can follow yourself and use yourself. You can also get a free PDF copy of my book, How to Value Invest. And you can also get a free copy of our guide, 7 tips to picking great stocks and 3 times you must sell. You can get all 3 of those for free in the description below. If you're looking for more specific help from me, you can get information on our masterclass below this as well. But until next time, have a great day. Talk soon. Bye.